Welcome everyone to our third webinar on a focus primarily on the Paycheck Protection Program, PPP. I think the headliner today is for the last 2 months, we've been talking about things we don't know and guidance we're expecting and all the unanswered questions specific to forgiveness. And fortunately, last Friday night, we had forgiveness guidance dropped on us. So that'll be the focus of today's webinar for the most part. So my name is Adam Sweet. I'm a principal in Spokane, Washington, part of our National Tax Office. And I'm joined today by Michael Holdren, who's a senior manager in Des Moines. And we're both part of our SBA, what we call our working group, which is a firm-wide working group focused on the Paycheck Protection Program, monitoring developments, and kicking out client alerts and so forth. So thank you for joining today. As always, we're going to have way more questions than we'll be able to answer. If they're common questions, we'll try to answer it on the webcast. Otherwise, we just encourage everyone to reach out to their local EIDL professional for further help. Just our website here, we have a dedicated landing page, eidbailey.com/PPP, that has all of our Paycheck Protection Program related guidance. We have insights, articles, links to our past webinars. So if you have a question, undoubtedly you can probably find an answer there. So the agenda for today, we're going to cover some updates on the EIDL program and then other miscellaneous items related to the PPP program. And then we're going to spend the majority of our time on the new forgiveness guidance, which is the new PPP forgiveness application that was released. So EIDL, these are economic injury and disaster and relief loans. This was kind of a companion program that came alongside the PPP loans. The big headliner there was that you could get a $10,000 advance up front. The SBA has kind of moved the goalpost on these a couple of times, and the latest iteration of these new goalposts is that right now only agricultural businesses are eligible for EIDL loans. So for a lot of our clients, this is closed, this program. Why agriculture? I don't know. It's not in the statute, but this is what the SBA came out with a couple of weeks ago. This is specific to the PPP program, and we talked about this during our last webinar. There was an open question about whether your PPP expenditures that are incurred during the covered period, and we're going to cover all this at length in the last half of this presentation, but whether those expenditures give rise to a tax deduction. And the question came from this, that the statute itself states that when your loan is forgiven, or if your loan is forgiven, the amount of forgiveness is not income. And that's an exception, because generally speaking, if I loan money to you, if I loan $100 to Michael, it's not income to Michael. But if I cancel the debt or forgive the debt, suddenly Michael has $100 of income because he's been enriched by that amount. CARES Act provided the PPP loans as an exception, so that you don't pick up into income the forgiveness amount. The statute was silent in regards to the expenditures, though, whether they give rise to a deduction. And I think many of us assumed that it would be tax deductible, because Congress seemed to say you get a tax benefit if the debt's forgiven, and by taking away a deduction, you would kind of negate the tax benefit. Well, as often happens with the PPP program, our best assumptions and guesses were proven wrong. The IRS in Notice 2020-32, which came out a few weeks ago, stated that qualified expenditures giving rise to PPP loan forgiveness are not tax deductible. So all those salary payments you're making right now to an employee during the covered period, not tax deductible. And it's surprising because it really negates the tax benefit that Congress seemed to have given. And I have just an example here of why that is, that you end up in a net neutral position. The income itself is not taxable, or the loan forgiveness is not taxable, but then the deduction, like if you borrowed $100,000 and incurred $100,000 of eligible expenses, when the $100,000 is forgiven, not income, but the $100,000 of expenses not tax deductible. So you're really in a tax neutral position. And it's the same position you would have been in just in a non-PPP area. So if I had just loaned Michael $100,000 and he'd used that $100,000 to incur $100,000 of deductible expenses, and then I forgave the loan, it would be a net wash to him. He'd have $100,000 of income, but he'd have $100,000 of deductions. The IRS with this notice put borrowers in this exact same position. Again, that's surprising because it would appear that Congress intended for a tax benefit upon forgiveness. You know, of course, we focus on the tax side of things, but the forest from the trees is that, well, you lost a tax deduction, but you still got full use of the PPP loan proceeds, basically free money, and that is true. So maybe it just, rather than having a full $1 of benefit, now you have 70 cents of benefit. Still came ahead. It just is a surprising tax result. Congress has stated, don't be surprised later this year if there's a fix. Congress has stated that they're going to make PPP expenditures tax deductible, and they're going to explicitly state it in the next round of stimulus. And this has come from both Democrats and Republicans. So I would expect this to be fixed. The question is when. I don't know when, but I would expect this to get fixed. Also, some have suggested even that the IRS's analysis is perhaps off in the notice, and that it may be possible, even if Congress doesn't fix it, it may be possible to take a contrary position on a tax return. I'd leave that to taxpayers and their advisors to think about, but some have suggested that you could take that position out there. There's a new rule this was another rule kind of created out of whole cloth by the SBA a couple of weeks ago, and it said that a single corporate group, you are limited to $20 million of total loans. And the single corporate group is defined as having majority ownership by a common parent, directly or indirectly. The statute says nothing about this. The statute just says individual businesses are capped at 10 million, but you could have 10 different businesses under common control. Maybe they're franchises, maybe they're the NICS code begins with 72, allowing them to escape the affiliate rules. And they could have borrowed, each of the businesses could have borrowed $10 million. It could have been 30, 40, 50, $60 million of total loans. This rule caps that at 20 million. Importantly though, we've had a lot of clients ask about this. It's only for loans that have not been fully dispersed as of April 30th, 2020. So you're grandfathered in. If you feel like this is your fact pattern, but your loan was dispersed on April 15th, you're exempt from this rule. For some reason, I don't know whether there's bad information out there, but I've had a lot of clients call worried about this rule, saying, do they have to give money back? Answer is no, if you're grandfathered in by the new rule. PPP loan eligibility. So this was a continuing saga over the last couple of weeks, and it was probably the #1 topic of conversation with our clients. Just by way of quick background, the CARES Act, which is the statute that created the PPP loan program, only required a borrower to make the below certifications. And for many of you, when you applied for your PPP loan, this is what you had to sign. You had to sign your name saying you needed the money due to the uncertainty caused by COVID-19, and that you'd use the money to retain workers. There was nothing there. You didn't have to state that you did not have another source of liquidity. In other words, if you had a credit line or if you had owner equity or retained earnings, that didn't seem to be relevant. And that was really our advice to most clients was, who cares if you have a credit line? Nothing in here says that you can't still take on a PPP loan. So most borrowers in very good faith applied for PPP loans and were funded, even if those borrowers had retained earnings or access to other sources of liquidity. The SBA threw a whole bunch of uncertainty into this, and I'm truncating this because there's a happy answer. But there was a whole series of FAQs released in trickle form, 31, 37, 39, 43, 46, and 47. There's some interim rules where the SBA threw a bunch of this into doubt. And the way the SBA did it was the SBA said as part of that certification, a borrower was supposed to take into account access to other forms of liquidity. And it seemed to indicate that if you had basically access to cash from another source, perhaps you were not eligible for the PPP loan, and that you should return the PPP loan if you were uncomfortable with that. Very unfortunate, created a lot of heartache for a lot of borrowers. People were worried about, could they go to jail? Could there be civil penalties? What would happen somehow if the SBA swooped in and said, haha, you weren't eligible for this loan? No one knew. SBA, after creating all of this uncertainty and all of this heartache and heartburn, came out with a Q&A last week. And what they said was, if your loan is under $2 million, you will have deemed to have made that certification in good faith. So there'll be no automatic review of your loan. If you borrowed in excess of $2 million, the SBA will review it. And I suppose part of that review will take into account whether you had access to other forms of liquidity and so forth. But importantly, what the SBA said was worst case scenario would be you just have to repay the loan. So if you borrowed $3 million, the SBA comes in and asks a bunch of tough questions. And if you're just like, if the borrower is like, well, we still think we're entitled to it, but to just be done with this process, we're just going to give the loan back, and that will settle the case. So no criminal, no civil, no jail, none of that. So it ended up being a very borrower-friendly answer. It was just very unfortunate that in the meantime, we had 2 weeks of uncertainty, and it really ramped up the uncertainty. It started fairly innocuously. The original FAQ started to talk about large companies, large publicly traded companies, and that was because those companies were in the news. You probably read about them, famous restaurant chains, national restaurant chains that received PPP loans. And in responding to those, the SBA kind of came out with a hammer and ended up creating rules that it would appear to affect all kinds of borrowers. So let's get in then to really the heart of today's session, and probably why most people are attending today, is the forgiveness stage of the PPP loan program. And before we dive too far into it, I just wanted to set the stage for what we're talking about. So the way the PPP program works is you borrowed your money based on 2.5 months of payroll, 2.5 months of average payroll from 19. Once the loan is funded, the clock begins on this covered period, which is the 8-week period starting on the date of loan funding. Why is that 8-week period important? Because you need to incur eligible expenses during that 8-week period, and the sum total of those eligible expenses incurred during the 8-week period can produce forgiveness. Not automatically, you'll see there's limitations to take into account, but the basic point or the basic gist is you have the loan in your account, spend it during the 8 weeks, spend it the right way, and if you do so, you'll get forgiveness equal to the amount you spent. And here are all the categories under the statute of different ways that you could spend that money during the covered period. Importantly, here, there's the 75% rule that I just can't emphasize this enough, that even though you have these different buckets of eligible expenses, the SBA has stated that still 75% of the eligible expenses 8 weeks must go to payroll. So what happened? So the new PPP forgiveness application was released on Friday night. I think it was Friday, 5, 6 o'clock. So a couple, 3, 4 days ago. And what it was is it's the formal application that a borrower will fill out to seek forgiveness and submit to their lender. And probably most importantly, that there's accompanying instructions along with the application that answered many of our open questions. So just to level set with that, this is the application. If you pull up this application on the internet, this is what you're going to fill out and give to your lender at the end of your covered period and say, lender, I borrowed $100. I should get the whole amount forgiven. And here's the application to prove that I did what I was supposed to do to get it forgiven. So that's the importance of this application. That's what this application is. People are hoping there may be additional guidance out there to help us interpret some of this. The Secretary of the Treasury, Mnuchin, threw a little bit of cold water a couple of days ago on that he felt that the application and instructions answered most of the important questions and that borrowers shouldn't expect additional guidance anytime soon. So we'll see if they stick to their guns there. So specifically to the application, I mentioned the statutory scheme is that you have this covered period, that's this 8-week period that begins on loan funding date. The problem for some borrowers is that if the focus of the PPP loan program is payroll, and if payroll's paid on a weekly or biweekly or bi-monthly or monthly basis, your 8-week period kind of arbitrarily starts when the bank plops the cash into your account, and that may not line up perfectly with your payroll periods. So there was some consternation there on the account of borrowers and their advisors of, would you be hurt somehow if your loan funding happened in the middle of a payroll period? Would that adversely affect you? Adversely affecting meaning somehow you wouldn't get full credit for your payroll. And I think the answer is no, it wouldn't adversely affect you. And the reason why is, one, strictly for payroll purposes, the application creates an alternative covered period, which allows you to start your 8-week covered period when your payroll starts. So rather than starting it on loan disbursement date, you can start it when your payroll starts. And the example, this second sub-bullet, is the example in the application. Your loan was funded April 20th, and your first payroll starts on April 26th. April 26th can be the start of your alternative payroll covered period. Importantly, it applies only for payroll expenses, but this will allow you to line up your payroll exactly with your 8-week covered period. Also, we gained some more information on what exactly eligible payroll costs are. And the ambiguity arose, the statute uses the term paid and incurred during the covered period or alternative. Of course, the statute doesn't have the alternative covered period, but the statute uses the word paid and incurred during the covered period. Paid is a cash basis concept, meaning just cash out the door. Incurred is more of an economic or accrual concept. What no one knew was that an either or test? Was it you had to pay? Was it you just had to incur it? No one knew. Well, we have more information on that from the application. First, what we know is that they defined paid to mean that the day that paychecks are distributed or the borrower originates their electronic deposit. So that's actually the cash basis test. Incurred is the day that the employee's pay is earned. So think about this way, that if you work for 2 weeks, each day as an employee, you're incurring a day's worth of salary. It would be paid at the end of the 2 weeks or the day that there's an electronic disbursement. What they told us is that you appear to have the best of both worlds if you've paid and incurred payroll costs. And why? Well, first of all, they told us that if you incur payroll costs during the covered period, so during the 8-week covered period or the alternative covered period, but you make payment outside of the covered period, you can still get credit for that because you incurred those costs during the covered period. So this is more of an incurred test or an accrual test. But what they also said was you can also include anything you pay during the covered period or the alternative covered period. And what it would seem to allow you to do, some borrowers, if they have the right fact pattern, they may be able to include an extra payroll period in their 8-week covered period or in their alternative covered period. Excuse me. So as an example, this is a quick example I sketched out. If your loan funded on April 30th and you paid, you have payroll every 2 weeks, and so you ended up paying payroll on May 1st, which is after your loan disbursement date. But remember, though, that payroll was for incurred costs from April 16th to April 30th before the loan funding. It appears that qualifies as an eligible payroll expense. And then also, along with that, presumably you could also include the incurred payroll expenses during that 8-week period or the alternative 8-week period. And it looks like the end result is, if you're a borrower, you could include 5 payroll periods in your covered period. 5 payroll periods representing 10 weeks, even though your covered period was 8 weeks. Looks like a very borrower-friendly rule. I mean, of course, the SBA never explicitly states this is what you can do. You're trying to read between the lines here, but we think this may be the government tacitly blessing this. Because if you think about it, really, this money ultimately is going to employees, it's not going to the owners, so there may not be as much room for abuse there. One important point I skipped over there is, don't forget, when you're incurring payroll costs, you're capped at $100,000 of an annualized rate. And what that breaks down to is $15,385 per individual during the covered period. So if you're five, in my example here, these 5 payroll periods, if that means that an individual employee is paid more than 15,300, you're not going to get the full benefit. You'll only get the 15,300 there. Another very common question we had from clients that we didn't know the answer to was, can you pay bonuses to employees during the covered period? And would those bonuses count as eligible payroll to give rise to forgiveness? We didn't know whether you'd be forced to somehow accrue those bonuses over a full 12 months and get less than full credit for it. The instructions seem to state that you do get full credit for a bonus. I call it a retention bonus. We've had a lot of clients state they have employees that are maybe worried about coming back to work because of COVID-19 or other issues. And the client's like, can we pay them a $500 bonus? Can we pay them a $1,000 bonus as basically a welcome back to work? And we think the answer is yes, so long as total pay during that 8-week covered period doesn't exceed the $15,385 or the alternative covered period. There's an important exception here. Owner employees or self-employed individual general partners, the amount that they are paid during the covered period cannot exceed 8 weeks worth of 2019 compensation for those individuals. And what that means practically is that it may be difficult to bonus owner employees or these types of people unless you bonus them during the equivalent period in 2019. So it seems to say cash bonuses work for non-owner employees, don't work for employees. And again, that makes sense. That may be the government trying to state, we're going to allow cash bonuses. We think it may be abusive in some cases if we're paying it to owners, so we're going to preclude that. But everyone who's not an owner, we're going to allow cash bonuses. The term owner employees, self-employed individuals, general partners, that's not defined. The other very common question we get is, can I put my sister on the payroll? Can I put my cousin on the payroll, my daughter, my son on the payroll? We don't know. There are no stated related party rules that forbid that necessarily. I think you'd still want to be careful with that. You don't want to have just a nominee on your payroll. I don't know if that qualifies as a true employee, but nothing necessarily precludes it on the application. So the non-salary portion, if you remember, payroll is salary up to $100,000 annualized plus benefits paid. We have some further information on the application for what those amounts are. And they're the sub-bullets here: employer contributions to health insurance, employer contributions to retirement plans, employer contributions to state and local taxes. The important point here is it's the employer contribution piece. It is not anything withheld from the employee's paycheck for any of these amounts does not count as qualified payroll, only the amount that the employer paid or incurred. Also note that the instructions explicitly use the term paid when discussing these amounts, not incurred. So if you have retirement plans where typically you're funding those at the end of the year, some plans even require that if they're age-weighted plans, if they're based on net earnings of the company for the year. Oftentimes you can only fund it at the end of the year. It would appear you may be out of luck here because you're not allowed to somehow accrue that expense during the 8 weeks to get credit for it. I mean, if you have flexibility, I think the answer is to pay that retirement if possible during the 8-week covered period. People that have 401k matches and so forth won't be an issue because those are on a paycheck by paycheck basis. More of an issue for people that have set plans or different types of plans that fund at the end of the year. You may need some creativity there to include those costs as part of the payroll. Michael, maybe just give us a little update on the 75%. What did we learn about the 75% rule?
Sure. So one of the most important things is it's not what we're kind of describing as a cliff rule. The eligible amount of forgiveness is a prorated portion of the forgivable expenses that's applied to your non-payroll costs. So originally there was a question out there that if you didn't hit this 75% threshold with the forgivable expenses, were you, out? Did you not have any forgiveness? But we did get the answer to that. And an example to kind of help illustrate Adam's kind of discussion on the bonus piece and this overall calculation is laid out here. So business gets a loan for $200,000. they incur 130,000 of eligible payroll costs and 50,000 of eligible non-payroll costs. So they don't quite hit the 200,000 threshold, and actually they don't quite hit the 75% threshold. The application tells us we need to divide the eligible payroll cost by 0.75, or the 75% threshold, to determine the total eligible forgiveness amount. Then we back into the actual eligible non-payroll forgiveness amount. So we take our that 173,000 that we calculated, we back off our payroll costs. So our non-payroll costs that are eligible for forgiveness are capped at just over 43,000. Now, when we look back at what Adam just talked about for those bonus payments, and specifically to the non-owners, it's interesting, and a potential solution to this, if you catch it soon enough within your 8-week period or prior to the end of that covered period, it appears that in this case, if you were to bonus an additional $20,000 to non-owner employees, you would then incur 150,000 of eligible payroll costs, meeting that 75% threshold, and thus be eligible to include the 50,000 of non-payroll costs as well. So the result is you have full loan forgiveness, and you eliminate that haircut to the non-payroll costs.
Thank you, Michael. So we covered payroll there. And as Michael mentioned, 75% of your eligible expenditures have to be payroll, but 25% can be non-payroll. So what did we learn there about non-payroll? A couple of things there. That this is, again, the categories that work as non-payroll expenses. They can be up to 25% of your forgivable expenses. One update there is in the definition of rent, it's rent or lease payments for real or personal property. We knew it was real property from the statute, but the reference to personal property is new. So then that brings in cars, trucks, anything non-real estate potentially qualifies as a qualified rental expense. So that's a new category, something to pay attention to there. Also, in the definition of a covered utility payment, transportation is new, and it relates to gas and different costs you may incur if you have automobiles, or if you have other transportation related expenses involved. And the key there, though, for all of the utility services or the rental payments or the covered mortgage obligations, that they all must relate to something before February 15, 2020. So if it's a brand new expense category you incurred, that's not going to work. As I mentioned there, limited to 25% of forgivable expenditures, but also similar to payroll, we have a very favorable rule here that in navigating the paid and incurred, both paid and incurred expenses count during the 8-week covered period. And it may allow some people to include extra expenditures. We've had that question, what about rent prepayment? What about late payments? What about penalties? If all these things are paid during the covered period, literally that meets the definition of paid. And it's not, it doesn't have to be just incurred, it can be paid as well. So it seemed to open the door to some of those things. I don't know how far you can push that. Maybe we'll have additional guidance from the SBA on that. This always comes up, these examples come up in the self-rental context, where you have an OpCo or an operating company and it's paying rent to a related real estate company. And so people are interested, could I make a double rent payment? And it's going to benefit the owner because the rent's not going to a third party, it's going to the owner. Literally, it appears some amount of rent prepayment works. How much, I don't know. Also, just remember you're limited overall to 25%. So that may be the governor on this, that there's some games to be played there, but because only 25% can go to non-payroll, that may be really the ultimate limiting factor. Ordering rules, and we're going to have some examples that cover this in a second, but I mentioned in the beginning, the only part of it is adding up all of your eligible expenditures that are incurred or paid during the covered period. So adding up your payroll, adding up your non-payroll. Next, what you do is to figure out how much forgiveness you get, and we've learned this from the forgiveness application, and we have examples here to flesh this out. But you then account for if you've reduced anyone's pay by more than 25, sorry, not anyone, certain employees pay by more than 25%. And if you have, you reduce your forgivable amount dollar for dollar. The third step is you account for FTE reductions. Your fourth step is you account for the 75% rule that Michael covered earlier. And then your ultimate forgiveness amount is the smaller of 3 or 4. So 3 would be you account for your salary and FTE reductions. 4 is you account for the 75% rule. The smaller of those amounts is your ultimate forgiveness amount. And we have the application here on a slide coming up to show that. And you'll see it as well. If you actually look on the application, you'll see this is how the ordering works. So what is FTE reduction? So FTE is full-time equivalents. The way the statute works is you compute your full-time equivalents during the covered period or alternative covered period, and you compare it to a reference point that was pre-COVID, pre-PPP. And you have the choice of a couple of different reference periods. And obviously, if you're a borrower, you're going to choose the period that's most advantageous to you, probably the period with the lowest FTE count. Those periods are listed there in the sub-bullets. But you add up your FTE count, you compare it to those periods. If there's been a reduction, that is your FTE reduction amount. It's a ratio that you come up with. So if there's been a 10% haircut to your FTE count, there'll be a 10% haircut to your forgiveness amount. Importantly, owner employees and self-employed individuals, general partners, are not included in this test. What we didn't know before was what is an FTE. And if you were with us on previous webinars, we guessed that an FTE was 30 hours a week based on previous SBA guidance. And like everything, we guessed wrong, of course, because the SBA wouldn't let us be right. And what they said with the application and the new rules that came out on Friday is 1 FTE actually equals 40 hours per week, and that a single employee can only produce 1 FTE. So if you have someone that's working a bunch of overtime and they work 60 hours in a week, they still only give you 1 FTE. If they work less than 40 hours in a week, you do the math and you divide it by 40 and you compute the fractional FTE. So my example here is if you work 28 hours, 28 divided by 40, that gives you 0.7 FTE. If you have a lot of employees, or if this gets complicated for you, there's a simplified method where you can just give 1 FTE for anyone working 40 hours or more, and 0.5 FTE for anyone working less than 40 hours. That may make it easier if you have hundreds of employees and it's just too laborious to compute all this. And again, as I mentioned before, if you're subject to this, it's a proportionate reduction. They call it the FTE reduction quotient. This is how it looks. This is directly from the application. This is how it looks that you, line 11 is your chosen reference period pre-COVID. Line 12 is your covered period FTE. You divide 12 by 11 and you get your reduction. Of course, if it's greater than 1, there is no reduction. If it's less than 1, then you have a reduction. Exceptions, and I'm going to carefully explain these because carefully meaning that there's kind of a hidden trick to all of this, that even if you meet the exception for FTEs, the ultimate problem sometimes is 75% payroll, but I'll explain what I mean by that in a second. But if you had an FTE reduction, there are exceptions. One exception is if you've made a good faith written offer to rehire an employee and the employee rejects it, they don't count against you. Also, if during the covered period or the alternative covered period, if anyone was fired for cause, resigned, or they reduced their hours, they don't count against you. Also, if you restore your FTE count by not later than June 30th, 2020, you can avoid what I'll call the FTE haircut. Now, I just say be careful with this because if you wait until the end to restore FTE, you may avoid the FTE haircut, but of course you didn't incur a lot of payroll during the covered period. So that 75% test is going to come back to bite you. So we have a lot of people focused on these safe harbors. Definitely helps. It just, you want to be careful. If you think that you're going to have to, rely upon these safe harbors, you're probably also going to be subject to the 75% test. Michael, maybe you walk us through an example here on how this works.
Sure. So when you put pencil to paper on all this, you'll find out that the difficulty and the complexity of completing these applications is probably as difficult as it is to hear and walk through the instructions as Adam's just laid out. But if we just give a basic example here, not focusing on when the loan was taken out or how much the loan was, just a basic example with small business had 5 employees. We're going to say employee, we'll call them employee A, makes over 100,000. 3 additional employees took pay reductions during the year, B, C, and D, and then 1 employee E was laid off during or prior to the covered period, but on April 1st. So then you'll see the tables here. These 2 tables, Table 1 and Table 2, are part of PPP Schedule A, and specifically Schedule A, the worksheet that accompanies the Schedule A. And we're going to focus on the 3 employees and then the 1 employee from Table 1 and Table 2. We already went through the calculation of determining the average FTEs that Adam discussed earlier for the 40 hours a week. So then we're going to go and use that information to determine if we have an FTE reduction. Perfect. So as Adam mentioned, first we have to compare those 4 FTEs. We have to select a reference period. Those 2 reference periods are listed there on the slide. We have a period from 2019 as well as a period from the first of the year in 2020. Both of those reference periods have 5 employees. If you had a reference period that had a fewer or a smaller number of employees, you would want to choose that. That would be to your advantage as a borrower. So then we take the number of FTEs from Table 1 and 2, and we compare that to our reference period. So we're going to look at 4 FTEs. We're going to divide that by our reference period, which is 5 FTEs, to come up with a tentative FTE reduction quotient. And in this case, it's 0.8 or 80%. At that point, if you don't have, if that number is less than 1, you can go into the safe harbor test. And in this part, we're going to determine FTEs for some additional periods. We're going to take a look at the period of February 15th through April 26th. And in this case, because we had an employee laid off during that period, we have just under 5 employees. They also ask you to look for how many employees were on the payroll, the pay period that included February 15th, 5 employees again for this example. And then also we go and look at that June 30th cutoff date, which if you rehire or establish the employees, bring them back on prior to June 30th or up until June 30th, you can qualify for the support for the additional employees. So in this case, employee E was rehired June 15th. So on June 30th, we had our 5 employees back. So in this case, the safe harbor test is met and our FTEs were restored by June 30th. So you would enter a 1.0 as your quotient on PPP Schedule A.
Thank you, Michael. The other reduction that the other forgiveness reduction to pay attention to is that in addition to reducing FTEs, if you reduce certain employees' salaries or average hourly wage by more than 25% during the covered period or alternative covered period, as compared to January 1st through March 30th, 2020, you reduce your forgiveness dollar for dollar by the amount. And it's just the amount that exceeds 25%. So you have a 25% cushion. If you go to 26%, it's that excess 1% that would reduce your forgiveness amount. It's also averages. If you remember from our previous webinar, the January 1st to March 31st is in the statute, and that's a 3-month period. We were worried the covered period is only 8 weeks. So trying to compare 8 weeks to 3 months, we were worried somehow that would be a borrower unfriendly rule. They fixed it by saying basically it's an average. You take your average during that 3 months, you compare it to the average during the covered period. A couple of important exceptions or exclusions. The reason why we say certain employees, one, any employee who's making over $100,000 annually is not included in this test. So if they make $105,000 and you cut their pay to $0, or $5, they're not included in this test. Also, similar to the FTE rules, owner employees and self-employed individuals, general partners, are not included in this test. Two very important exclusions. If you look at the application, I think is it table 2, Michael, where you put these amounts?
That's correct.
There's a couple of different tables if you look at the application, and if you wonder why you have to list people making over $100,000 separately from people making under, this is why, because it's the table 1 you would apply this test to, not table 2. Again, if the salary reduction applies, it's a dollar for dollar reduction to the forgiveness amount. Safe harbor, similar to the FTE, you can avoid this haircut if you restore salary or the wage reduction by June 30th. Again, though, don't take too much comfort here, because if you wait to restore everything by that point, you may not have incurred enough payroll expenses during the covered period to meet that 75% rule.
So another example is actually just continuing on the same example. Again, we're showing table 1 and table 2 that Adam just spoke of. Table 1, you're going to list out all of your employees. If you have 5 or if you have 500, all of those employees are going to be listed. You're going to list the compensation during the covered period. As I mentioned, you're going to go through that FTE calculation to determine how many FTEs that employee counts for. And then in this part of the example, we're going to go through that salary and hourly wage reduction piece. And again, this, as Adam mentioned, this is applied specifically to those individuals in table 1 because they're the individuals that make less than 100,000. So when we take a look at the example, there's essentially a 3-step process that you have to go through for the example. The first step is you're going to determine if any of the employees that are listed in table 1 have that salary or wage reduction in excess of 25%. So in our case, you can see in step 1, we have 2 employees that meet that salary reduction, employee B and employee D. And what you're doing here is you're taking either the annual salary or the hourly wage, and you're comparing that to the same salary or wage for the first quarter of 2020. When you divide those out, that's how you determine if that reduction is in excess of the 25%. For those 2 employees, then you go on to step 2. And for step 2, we're going to test that safe harbor again. We're going to look at the annual salary for a few different periods, or the hourly wage. In this case, February 15th, that same February 15th to April 26th period, and then as of June 30th. And in this case, in step 2C, you can see as of June 30th, we did not restore the salary or hourly wage back to the reference period. So in that case, we need to take another step and go on to step 3. In step 3, you compare employee B and D. So for this period, we're going to determine what 75% of the covered wage, of the original wage for the period of January 1st through March 31st is. So for employee B, we're going to take their $95,000 original salary. We're going to take that times 75%. And then we're going to compare that to their actual salary that they were paid during the covered period to determine the amount in excess of 25% that their salary was reduced. Now that's an annual number because we're using annual salaries. So in order to get that to the actual covered period or salary for 8 weeks, we have to multiply that amount by 8/52. That number, that 962, is what would be transferred to Schedule A worksheet, Table 1 for that specific employee. For employee D, we go through a similar calculation, but we're going to instead compare the hourly wages and determine the amount in excess of 25% that the hourly wage was reduced. In this case, it's 75 cents. But for an hourly worker, we need to determine the number of average hours worked. So in this case, it was determined to be 40 hours. That then needs to be grossed up because that's a weekly amount. So we take that amount times 8. And that $240 is what would transfer into Table 1 for Employee D for the amount of hourly wage or salary in excess of 25%. So clearly not an easy calculation to go through. However, there is a spot on the application if you, as a borrower, had no salary or hourly wage reductions. There is a box that you would check for that and simply places 0 on the application. So this would not apply in that circumstance.
Now, Michael, did they make this form fillable? Does it do the calculations for you when you fill out the form?
Unfortunately, there is no Excel-based form, or the PDF does not have any formulas. So it's right now it's all handwritten. So it's if you have a number of employees and you did in fact reduce salaries or wages, this will be a pretty extreme exercise to go through depending upon the number of employees.
Yeah, I would agree. We heard from some people that they were hoping before Friday, they were hoping the forgiveness application would be some type of automatic formula-based product where the SBA would have done all the work, and as the borrower, all you had to do was somehow go online and punch in a few numbers, and the SBA would tell you what your amount is forgiven. I think the answer clearly is no. Even it starts with that the product they put out is not even fillable. It's literally, you know, you could make it fillable, but otherwise you're printing it out and doing it by hand. So we think if you thought it was complicated to apply for the loan, which it was, especially at the time, because there were a lot of things we didn't know, it's going to be at least as complicated and probably way more complicated on the forgiveness side of things. And it's going to be complicated for both borrowers and the banks too, who are suddenly going to be inundated with these applications. So just a heads up to people that, again, be thinking about it now. We have some products that can help. I know there's other products out there too on the internet. So be talking to your local Bailey professional or whoever else your tax professional is, and start planning now. If you have any complexity to your situation, start planning right now for how you're going to get through that, because I think it's going to take a significant amount of time for a lot of people, unfortunately. This is just literally I cut and pasted right from the application. This is what Michael just went through. This is the table 1 and table 2, but this is just what it looks like. If you look at the actual application that was released on Friday, this is what it looks like, where you'd list each employee's name, their identifier, their cash compensation, average FTE, and then the salary reduction. Brings us to our third polling question. Both FTE and salary reductions can reduce a borrower's forgiveness amount. True or false?
All right, that third poll is now open. Feel free to answer while Adam and Michael continue on.
What's on the horizon with the PPP forgiveness? There was a bill passed this week by the House of Representatives, and I think the Senate has indicated that it is amenable to parts of the bill. I think it depends on a little bit how clean it is. By clean, I mean if either side starts sticking in extra stuff, then the bill becomes less likely to get passed. But in essence, what the bill does is it would extend the 8-week period to 12 or maybe even 16 weeks for some borrowers, giving you more time to incur eligible expenditures. When they passed this PPP program, I think originally they're anticipating these state shutdowns would be shorter in duration. That's why they came up with 8 weeks. You know, many states are already more than 8 weeks into a shutdown, and the shutdown may go for a couple of weeks longer. So that's why they're going to expand the period there. There's also the bill that's proposed in the House of Representatives relaxes the 75% payroll rule too. And it says that there's no forced ratio. When you incur eligible expenditures, it could be all rent if you wanted it to be. And this is important for certain industries like restaurants, where really what they need right now is help with overhead. They don't need help with payroll because they're not operational. But I think the important question for borrowers is, when is this going to happen? Many borrowers' 8-week period is maybe halfway, 3/4 of the way through. And if these rules come out in June or July, it's not going to be of help to a lot of people. So I don't know. It's probably going to get passed. I just don't. I wouldn't want to. I saw someone earlier asked, "How confident are we this is going to happen?" I don't know, Michael. Thoughts on? I mean, it's probably going to happen, but the way Congress works, I wouldn't want someone to take my word for it.
Yeah, I mean, we've been burned quite a few different times that you've mentioned. I think potentially you could wait to file, you know, if you're in a real hurry to file right at 8 weeks and they haven't come out with legislation extending it, and you expect that could be the case, you could potentially wait to get the benefit of additional time to earn or incur those forgivable expenses.
Yeah. So at the very end of the application and instructions, there's a page that states what documentation a borrower must submit along with their application. Some people, again, were hoping somehow that you would just fill out the application, submit it, and that would be it. Well, you do fill out the application, but then along with it, all of this documentation that they list out here needs to be submitted along with it. So payroll records, FTE records, non-payroll records. And you'll see there that it's a mix of tax forms, bank account statements, invoices. There's different examples. And it's not necessarily that you're going to have to submit all of these things, but probably submit enough to document each of your expenses on there. And this has to go to the bank with your application. What we don't know is whether somehow the bank is going to be the one that has to double check all this. Are they going to be reviewing your documentation and matching that up to what your application is? The way the form works, the bank is supposed to be able to rely upon the borrower's certification that they did everything correct. So, but there's obviously some balancing act here where there's some oversight requirement, let's call it that, on the part of the lender, where if they see some egregious error or something not documented, then there may be pushback to the borrower. And then this is a list of stuff that must be maintained by the borrower for 6 years. Doesn't have to go to the lender, but must be maintained by the borrower for 6 years. 6 years is important because the SBA seems to be saying here that there's basically a 6-year statute of limitations on this. That if you borrowed under 2 million, meaning that you don't get automatic review of your loan by the SBA, still the SBA could come in year 4, even after you've had your loan forgiven and you think you're done, the SBA could come in year 4 and somehow audit you. So that's why they said keep everything for 6 years. I don't know practically if they're going to really do that, but that seems to be the shot across the bow that they're putting there. So this is a list of things that you'd want to maintain there in your own books and records. And I think that brings us to our last polling question. Borrowers must submit documentation to support their forgiveness application. True or false?
All right, that last poll is now open. Feel free to answer while Adam and Michael continue on.
So that brings us to the end of our hour exactly. So perfect timing. Maybe Michael, just kind of last thoughts on what borrowers should be thinking about here over the next while. I mean, let's just not so much what Congress may do, but what should people be thinking about now that they appreciate the complexities involved? What should people be thinking about?
Well, I certainly think planning ahead, if you can, or what, now that you know and have heard some of the insights that we shared today, how does that impact your forgivable expenses? We kind of have some certainty in the calculations. There appears to be some favorable treatment over if you were one of the original kind of initial people to get into the program. You have maybe 2-3 weeks left in that covered period. Are there ways that you can kind of try to help manage your expenses to take advantage of some of those borrower-friendly regular or items that we pulled out? So and if anything, reach out to us. Let us know if you have questions or your local Eide Bailey professional, and we'd certainly be able to help you out in that arena.
Yeah, and with that, I see we have a whole ton of questions. It just there's just frankly too many questions with this for us to get through. But I would just encourage you to reach out to your local Eide Bailey professional with your questions. They should be able to help you. And if we have common questions, we can certainly address them on the next webinar. So with that, I'd like to thank everyone for attending and spending the hour with us. And we'll be back with you as soon as we have enough material for the next webinar. We'll be back with you. And hope everyone stays safe and talk soon.
Awesome. Thank you all so much for attending. Thank you, Michael. Thank you, Adam. Have a great day.